My name is Breon Mills and welcome to my channel. People invest in the market for one ultimate reason, and that's to make money. And the stocks we invest in generally fall into three categories: growth stocks, value stocks, and income stocks. We're going to take a look at each category, and by the end of this video, you'll walk away with a better understanding of the three so you can make better choices for you and your future. How does that sound? Growth stocks are stocks that investors anticipate growing at a rate that beats the market. A typical growth stock can grow anywhere from 25 to 100% in one calendar year. These companies reinvest all of their profits back into the company in order to accelerate growth and increase their value, which equates to an increase in share price. Investors then earn money through capital gains when they eventually sell their shares. Basically, you buy low and you sell high. Now, there are some risks when investing in growth stocks. Because growth stock companies usually don't share their profits with investors, the only way you can make money is when you sell your stock at a higher price. Now, if the company has a poor quarterly earnings report, it can cause the price of the stock to fall, and now you are forced to hold that stock at a much longer period or take a loss when it's time to sell. Now, some of the more commonly known growth stocks are Amazon, which has had a year-to-date return of 35%, Nike, which has had a year-to-date return of 17%, and Square, which has had a whopping 91% return year-to-date. Now, investing in the right growth stocks can deliver huge returns and definitely boost your portfolio. A value stock is a stock that tends to trade at a lower price relative to its fundamentals, its earnings, its sales, making it appealing to value investors. Now, a value stock is a stock that's trading at a lower price than what the company's performance may otherwise indicate. Basically saying that this specific stock is trading at $20 per share, but based on fundamentals, it should be trading at $40 per share. These type of stocks are attractive to long-term holders. Warren Buffett has made a fortune from seeking out and investing in long-term value stocks. One value stock that comes to mind is Disney. Disney is currently trading at around $110 a share. As long as children are here on this planet, Disney will always be here. Many analysts rate Disney as a strong buy and suggest that it should be trading somewhere in the neighborhood of $144 a share. Another one is Starbucks. Starbucks is currently trading at around $65 per share. Starbucks have plans on increasing their global footprint. They're trying to go deeper into China, and also they're going to have a share buyback program over the next 2 years. With these common factors, we could expect Starbucks to be trading in the area of $130 per share in the next 2 to 3 years. Now, income stocks are stocks that pay a regular dividend. If you're unfamiliar with dividends, when a company earns a profit from their business, the executive leadership team has one or two options. They can choose to keep the profits and essentially reinvest them back into the company, or they can share their profits with shareholders throughout the year. Most income stocks are less volatile than the overall market and offer higher than market dividend yields. Income stocks may have a limited future, limited growth options, thereby requiring a lower level of ongoing capital. So any excess in cash flow from profits can be directed back into the investors on a regular basis. The more money they make, the more money you make. Income stocks can be from any sector, but they're basically more commonly found in real estate, the energy sector, utilities, natural resources, and some financial institutions. Some of the commonly known income stocks that you may be aware of is Verizon. They're currently paying out a dividend of 4%. AT&T, they're currently paying out a dividend of 6.8%. And my all-time favorite, NLY. And NLY is actually paying out on average between 9 to 12% yearly on average. So just think about this. So if you have $1,000 in a specific stock, say NLY, and they're going to pay you 12% interest. So they're going to pay you $120 a year for every $1,000 that you have in NLY. You can't beat that. So income stocks are very dependable stocks that you can rely on to provide you with a steady stream of income over the long term. And there you have it. Growth stocks, value stocks, and income stocks. So let's recap. Growth stocks are stocks that should exceed the market average. Value stocks are stocks that are underpriced and we want to jump in while the price is low and ride that wave up. And dividend stocks, right? Dividend stocks that share their profits with you throughout the year. And so when you think about this, when you're building your portfolio, you can focus on one sector or you can invest in all three based on your financial goals that you have set for yourself. When selecting stocks, one piece of information investors use to quickly gauge whether a company is a good buy or not is called the PE ratio. In the next video, we're going to review the PE ratio, what it means, where to find it, and how you should use it to affect your decision making. Look, you could have been anywhere in the world, but you're here with me, and I appreciate that. So like, share, subscribe, and come on back for more wealth building information. Peace.